Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about why should you or would you refinance. And just a quick hint, it's not what you think it might be, which could be or is mostly to obtain a lower interest rate. That's what people think is the key reason to undertake a refinance. But I can tell you as an active investor myself, that is not been the predominant reason or primary reason or really any reason for me refinancing. Anyway, I want to talk about this because, it's a bit topical at the moment. According to the Australian Bureau of Statistics, for the year ending May 2020, there was a 63% increase in people refinancing. So obviously that's happening at the moment. I guess people are at home. They've got a little bit more time on their hands and they can pay a little bit more attention to their personal financial situation, which is a good thing, of course. But I wanted to just have a chat or a discussion about what's the point of refinancing and what should you be focusing on other than interest rate, because typically you don't need to refinance to obtain a lower interest rate. So if that is your primary or only concern, then there might not necessarily need to be a refinance involved. Anyway, before we get into the discussion, let me just firstly clarify, a distinction between an internal and external refinance. So there's two types of refinances you can do. And essentially a refinance is a recontracting of a loan. That's what it is by definition. When you take out a loan, you sign a loan contract. If you want to vary that contract or refinance into a new one, you have to sign a new loan contract. That's what refinancing is. You can do that what's called internally, so with the same bank, just recontracting a loan. Or you can take that loan to a completely new lender, and that's referred to as an external refinance. Might sound like I'm splitting hairs here, but some things you can achieve with an internal or external refinance, but some things require an external refinance to be able to implement. So anyway, I just wanted to put that out there. As I said, over the past 20 years, personally, for my mortgages, and I refinanced my mortgages earlier this year, I have never refinanced because of interest rate. And I think that's a really important thing because quite often the media talks about lower interest rates, switch lenders, etc. I'm going to talk about how do you approach your lender to get a lower interest rate and therefore avoid a refinance. I'm going to talk about that in a second, but there's other benefits or drivers to refinancing. And really there's three reasons to undertake a refinance. To restructure your loans is the first one. To extend or maximize your borrowing capacity or borrowable equity. And the third reason is due to cost. It is possible that you're stuck at a lender that actually won't give you a lower interest rate, and therefore, if that's the case, you may need to refinance, although that would not be common these days. Okay, so let's talk about these three reasons and give you some examples. So the first one is to restructure your loans, and the loan structure that you have can impact or affect your cash flow and your ability to invest. So we help clients restructure loans, and that could extend to restructuring how loan repayments are set up, so interest only, principal interest, structure how loans are secured, so which properties is used as security, reset loan terms. We could be consolidating two loans into one, for example, if they relate to the same investment. All these sorts of things go towards improving one's structure and also positioning them to reduce risk, reduce cash flow or improve cash flow, or give them ability to continue to invest. Probably there's three common situations or scenarios that fall under the restructure your loans reason for refinancing. The first one is resetting interest-only terms. So this is particularly relevant for investors An interest-only term means that you only have to pay interest in respect to the loan, no principal repayments. An interest-only term typically lasts for 5 years. Once that term has expired, pursuant to the loan contract, the repayments will automatically convert to principal and interest. Particularly for investors, most lenders allow you a second interest-only term without needing credit approval. So it's a relatively simple process. So it's possible that you roll over for a second 5-year term. But then beyond that, typically to get a third and fourth and fifth interest-only term, not impossible, but requires an external refinance. So that is, you've got to go to a completely new lender, rewrite the loan agreement again, and start that process. These days, banks are reluctant to give you kind of evergreen or everlasting interest-only terms. So quite often that's something that we're looking at for our clients in terms of refinance. The second common one is resetting the loan term. So it's quite possible that you've been on interest-only repayments, you're quite happy to let the loan convert to principal and interest. So particularly in a low interest rate environment, you might actually prefer to start repaying debt. But if you've already had a couple of interest-only terms, your problem is going to be that your remaining loan term will be too short, and that will extend or increase your minimum repayments. So let me give you an example. All loan terms, or almost all loan terms, are 30 years. Typically, if you take out a 30-year loan that's interest-only, the first 5 years will be interest-only and the remaining 25 years will be principal interest. If you have a second interest-only term, that means you've used up 10 years of that loan agreement, which means the remaining loan term will be 20 years. And so when the loan flicks over to principal interest repayments, your repayments will be calculated over a 20-year period. So, for example, if you had an $800,000 loan over 20 years, the repayments are nearly $4,500. However, if we go and refinance or rewrite that loan, and that could be an internal or external refinance, and reset the loan term back up to 30 years again, your loan repayments are about $3,400, so about $1,100 per month lower because the loan term has extended. So that is appropriate again for people that are quite comfortable to go over to P&I repayments, but don't necessarily want to make sure that they set their minimum repayments at the lowest amount, which is prudent to do. So even if you're comfortable with repaying $4,500, it is actually prudent to set them lower. Then go ahead and pay the $4,500 a month. But should your circumstances change, you can always reduce them back to the minimum. And the third reason that falls under the first scenario, I should say, that falls under the first reason to refinance, which is restructure loans. The last one is release of security. So this is important in terms of minimising your risk. So that is giving the bank less security than what they might need. And also ensuring that tax deductions are never compromised, so splitting out loans by purpose and in particular, which investments that they relate to. So what we would typically do if a client's thinking about divesting of a property, we will consider doing two things. The first one is we will seek to release that property as security. And the reason why is that we would much prefer to have an unencumbered property to sell, because then the investor has complete control over that cash flow. However, if you have a mortgage against an asset, the bank can then control that cash flow. So, for example, they might force you to repay other loans, depending on your financial circumstances, when you might not want to. You might want to put the money in the offset, for example, or something like that. The second thing we will consider is whether we should hang on to any existing loans and just change the security. And that would be particularly relevant for people that have a limited borrowing capacity and they might actually have access or their loans that are currently set up are more than what they could otherwise obtain today. And we might want to preserve those limits. So repaying loans when you go and sell a property isn't always the best thing. there's other restructuring things that we will undertake, including consolidating accounts, splitting loan accounts out, releasing other property as security, etc., etc. It all goes towards making sure that the investor can implement their plans according to how they want to do it, rather than how the bank wants to do it. So that's the first reason to refinance, to restructure your loans. The second reason, predominant reason to refinance, is to maximise your borrowable equity. And maximising your borrowable equity is very important because it gives you, or it maximises your access to future investment capital. And that's either going to help you build your investment portfolio and or help you achieve lifestyle goals. And I'm going to talk about how borrowing capacity is not an infinite resource. It's a finite resource, and that's why we need to proactively manage it. So there's, again, three scenarios under the maximise borrowable equity reason, three common scenarios that I can talk about. The first one is bank valuations. So it's not uncommon for a valuation of the same property at the same time, but undertaken by two different banks to differ by several hundreds of thousands of dollars. I've had it myself personally, where the differential in valuation has been $300,000 or $400,000 on the same asset. So it's kind of ridiculous. Probably shouldn't happen, but it does happen. And an extra, a valuation that's a couple $100,000 higher can be the difference between being able to invest or not invest. And that's going to help you maximize your borrowable equity. Of course, I'm not suggesting we go and borrow regardless of considerations of cash flow and risk appetite and all those sorts of things. But let's just assume under this scenario that it is prudent and comfortable for this client to borrow additional monies. It's really just depending on the valuation. Well, using or looking at having firstly a realistic assessment of the value of your property is important, and then finding a bank that shares your viewpoint is critical in terms of implementing. So sometimes you have to switch lenders in order to access equity. The second one is higher borrowing capacity. Now, I've spoken a lot about credit policy and how credit policy varies between lenders, varies between scenarios. So some lenders will suit different clients in different scenarios better than others, but also it's an ever-changing world as well. So whilst, for example, CBA might have the highest borrowing capacity for me today, there's no guarantee that CBA will also have the highest borrowing capacity for me in, say, 3 years' time or even 3 months' time. And so sometimes to extend your borrowing capacity, to move to a lender that's going to apply a little bit more common sense to your scenario, sometimes it's important to switch lenders. And again, an external refinance is what's required there. And finally, the other reason is to put some distance between a previous credit assessment. So the problem is that if you go and apply for a loan from a lender A, and lender A assesses your situation and says, look, we like it, we'll lend you the money, but we think you're at your limit. There's nothing more to give you. If you then go back to that lender A in 1 or 2 years' time, and the credit assessor picks up a file, and it'll be a different credit assessor, they'll read the notes from the previous credit assessor. And if the notes say, this is the limit, we don't want to give this person any more money, even if your circumstances have changed, what you need is a brave credit assessor to overrule and stick their neck out and approve your loan. Even if, in the absence of that comment, they would do so, that comment will be a legacy problem for you. And so sometimes the only way to get around this issue, and I've had it myself personally, is to switch to a different bank. You get a fresh pair of eyes. You don't have the history that you need to deal with, any notes that have included in the credit file, and it will be based on its merits rather than what the previous credit assessor thought. So again, sometimes you just got to play the game and understand this is how it works. Now, if you understand that a credit assessor is assessed on the loans, the performance of the loans that they approve, and that will directly impact their remuneration and also job security. So if you're a credit assessor, why would you stick your neck out and put your job on the line, or put your bonus on the line, or put your remuneration on the line just to get a loan approved? Most credit assessors aren't going to do it, and so that's the issue that you're going to have. The third and final reason to refinance is to reduce your overall cost. Again, I'm going to talk about in a second that there's a way around this. You don't necessarily need to complete an external refinance, but sometimes there's situations where a lender will offer you a much higher interest rate discount or a much better fixed rate, and your existing incumbent lender won't match it. And in that circumstance, it might be worthwhile then refinancing. A lot of lenders are offering cash incentives to refinance, for you to bring their loans to them, and will pay you somewhere in the order of $2,000 to $4,000 to offset the cost associated with refinancing, but really to incentivize winning new business. If you do refinance, there's 3 fees you need to be aware of. Your existing lender, your incumbent lender, will charge you a discharge fee, and that's really to the administrative work of discharging the mortgage over and the loan. Then there'll be a settlement fee charged by the new lender. Sorry, that discharge fee is about $300. Then your new lender will charge you a settlement fee, and again, that's to register the new mortgage and set up the new loan and so forth. And the third will be a mortgage deregistration, registration fees. These are government fees, and typically they range between $200 and $300 per security. So per loan, you're looking at almost $1,000 in fees to refinance. So if a bank's going to pay you $2,000 to $4,000, you could almost be better off from a fee perspective, let alone interest rate perspective, going through a refinance. But if cost is your only concern, then what I would recommend is that you pick up the phone and speak to your existing bank and ask them for a higher interest rate discount. Of course, they're not going to do that proactively. They're not going to be ringing you. You have to ask for it. The lender must feel like you are ready to walk. So it's really important to make sure that you're asking in a way that says, if you don't give this to me, I'm going to your competitor, as opposed to, can I please have a higher interest rate discount? And therefore, it's important to cite a competitive offer. And if you need any help with this, don't hesitate to reach out to Jodie McEwen from our team. She can give you maybe some pointers of what to say and what to ask for. And you should probably do that before contemplating switching lenders. So at least give your existing lender an opportunity to retain your business. Now, let me talk about why the first 2 reasons are more important than the last. And the reason for that is that borrowing capacity is a finite resource. It's a scarce resource, and it's becoming scarcer. No one has an infinite borrowing capacity, because our borrowing capacity is either restricted by 2 things. Either our own financial position or risk appetite. Some people just don't like borrowing, or, based on their cash flow, they would only be prepared to borrow an extra $1 million, for example. Even though if lenders will be happy to lend us more, that's what we're happy to borrow, that's fine. Or the second thing that will limit it is the banks. So I might be willing and happy to take on another $1 million worth of borrowings, but if the bank will only be willing to lend me $500, then that's what's going to restrict it. But either way you cut it, everyone has a limited amount of borrowing capacity. So therefore, it stands to reason that you absolutely must do 2 things. The first thing is, that's if you're going to be a successful investor, of course, the first thing is to safely maximize it. Now, I'm not suggesting people go out willy-nilly and start borrowing to ridiculous level. That's not what I'm saying. 100% not what I'm saying. You need to be absolutely prudent, and you need to be conservative, in my view, with respect to borrowing capacity, and have a strategy on how you're going to repay that debt at some point as well. But the point is that that investing is more a game of finance than it is really investment assets. And it's really about proactively maximizing your borrowable equity, and refinancing is a really good way to do that, again, depending on your situation. Over the last 20 years, the only time I've refinanced is to either access borrowable equity or restructure my loans. I've never refinanced to get a lower interest rate. As I said, you can pick up the phone and ask for a higher interest rate discount, and access to a higher borrowing amount or reducing your cash flow is going to make a much better, it's going to have a bigger financial impact long term on your asset base than saving 0.3% or 0.03% even sometimes. The interest rate that you pay isn't a big deal. It's really how you structure your loans and how much access to investment capital you have. That's the key thing. How often should you refinance? Well, I typically refinance my loans every probably 3 to 4 years, I would say. Look, I never plan to leave my existing lender. I'm happy to stay with them as long as they're willing to accommodate my reasonable needs. I'm not unreasonable about what I'd like to do. If I think I'm in a position where I can acquire another investment asset and my existing lender is saying no, I'll go and find a lender that will say yes. And this has helped me continue to build my investment portfolio and, most importantly, achieve my lifestyle goals. And as I said, it's a bit of a game sometimes. Quite happy to stay with the same lender for 10 years if, as I said, they're going to accommodate my needs. Unfortunately, it just rarely plays out that way. If you're not an active investor, you've got a whole bunch of assets, you're not really changing your debt very much, then refinancing less often is probably, you probably don't need to refinance every 3 to 4 years like I do. Final word is that refinances, particularly now during COVID, aren't a simple or quick thing. A refinance these days takes 2 to 3 months to complete from start to finish. A lot of lenders are having sort of back office processing issues or delays, again, related to COVID and so forth. So if you're going to go through a refinance, patience is very much a virtue. So there you have it. They're the 3 reasons to refinance. That is to restructure existing lending, to maximise borrowable equity, or to reduce your cost. If you'd like to learn a little bit more, I am hosting a webinar on the 12th of August at 12:30 p.m. And you can register for that. The link is in the show notes and the blog on the website. The webinar is the 5 steps to safely maximise your borrowable equity. And during the webinar, I'll be interviewing Jared McCabe from Wakeland Property Advisory, because valuations, property valuations are a key component. And I'm going to interview him because he used to prepare property valuations, particularly for banks. And I'm going to ask him, how do we go about maximising those? So if that's of interest, I hope you'll join me next Wednesday on the 12th of August at 12:30. Thanks very much, and until next week, bye for now.